Roar here with the aftermarket analysis and outlook for the S&P 500 future on Monday, September 30th, 2013. And this is all with a government shutdown in the U.S. imminent after the continued gap between the positions of the Senate Democrats and House Republicans. And this will be fairly short and sweet because most of what we see in the international multi-asset class view is still very much the same as we noted from the weekend in the videos that were posted or sent on this morning. And essentially, the other markets are showing where the govies have remained firm, even though they did not really push any higher in the wake of today's gap lower and continued weakness in the equities. The short money forwards have also remained firm, and the other currencies have continued to keep their bid against the US dollar. And as we've noted previous, in many cases, weakness of the equities actually creates a bid in the dollar on the concerns over any weakness in the global economy affecting others much more than the US. However, when the specific reason for equities weakening is in the US itself and looking like it might continue for a while, then the dollar can come under pressure. And all the levels, such as 80 even in the dollar index, the resistances the other currencies have escaped, etc., remain the same. Back to the S&P 500 future, what we have is quite simply a gap lower onto what was interim channel downside acceleration, an attempt to clean up that only got back into the middle of the 1682 to 1678 support, which we will revisit on the intermediate term charts, why 82 and areas like that are so important. And of course, getting back up right just above 1680 only tests the low that the market held in the middle of that range on the way down on Friday prior to this morning's gap lower. So it looks pretty negative. But the short-term indicators are still kind of muddled, even though we do have ostensible buy signal still on the hourly stochastic. The late weakness brought in a sell signal on the 30-minute. 30-minute MACD is flattened out completely, and interestingly enough, the 60-minute MACD remains below its lower runaway band in spite of the degree to which it is snugging in just below it. So this only highlights the degree to which any activity above 1682 to more convincingly, let's say at least a couple bucks above it, back above 1684, would probably signal the degree to which the market is trying to get good again, maybe on some sort of either last-minute compromise or early Tuesday morning ability and willingness to negotiate between the Senate and the House, or anything that fails to get back above the low 1680s probably points toward lower ground on this downside acceleration and continued weakness of the 60-minute stochastic. Now, the importance of the 82 area is that on the Larry Summers withdrawal from the race for Fed chairman news over the weekend after Friday, September 13th, the gap higher in the December daily contract was from 1682. So even all of the weakness going into Friday when the market closed off that gap higher but managed to close back above 1682 looked like it might be a holding action. It's also important Fibonacci retracements right into levels like 1684 to 1679 or so. And this is the lower of the two upside runaway gap attempts, first on greater accommodation sense out of Summers' withdrawal, and then the FOMC surprise a week ago Wednesday. And the September contract was still lead contract, so on the weekly chart, that gap higher 2 weeks ago was from 1688.60, which the market had already closed off and closed marginally below last week. So as we look at the market today and we say, okay, it's held into the weekly averages here, the 9 and 13 week average in the 1676 to 70 area, that's all fine and good. But right now the market requires a push back above 1682 to even, shall we say, maybe the mid 1680s to show that it is trying to get back above the daily exhaustion gap. Now upside runaway gaps that the market closes back below become exhaustion gaps, and if not, just in the general pattern where we're also back below this big pre break high from the initial euphoric response to Bernanke's Joint Economic Committee testimony back in May, lead contract at 1685 area, which is another reason this 1680 to 85 or so is so important, and all of the congestion as the market was churning up around that as part of topping out in August after the initially constructive U.S. payrolls report, before its break back down to the 1630 to 25 support that remains very important. And that's what we've got. So we're looking at a market that has another gap down to 1662 on this close, but essentially the more so it can't recover back above the low to mid 1680s points toward a bigger correction once again. Even if it's not going to get back down to 1630 to 25, you could think in terms of mid to low 1640s, retesting all of this congestion and the up break, and it would still frankly be exhibiting bullish tendencies overall in spite of another correction if it were to break down and hold 1630 to 25 again. So still an uptrend, but the question is whether in the context of this U.S. government partial shutdown it can indeed get its footing now and push back up immediately, or will be in for further worries regardless of how the economic data might come out over the next few days for the balance of this week. It's really all about the psychology surrounding the congressional gridlock on the continuing resolution to fund the U.S. government. Here we are back at the short-term charts, which once again further illustrate the importance of mid 1680s as the buffer above 1682. Here, by the way, is the level that we isolated the market closed at back on Friday the 13th to show you how long it's spent above that gap and only closing it Friday and being below it today, or whether failing that is potentially headed down for bigger lower supports. That's it for now. Anyone who'd like more detail on the other asset classes and markets, by all means, we encourage you to look at yesterday's, the weekend's fixed income and equities analysis on one hand, and our other video on the foreign exchange analysis. Again, those are out of Sunday evening. Bye for now.